There you go, the Reserve Bank governor addressing journalists there just after the MPC had decided to leave the repo rate steady, which means that the repo rate at the Reserve Bank, 6.5%, your prime lending rate at the banks, of course, 10%. Lesetja Kganyago here talking about the risks to inflation. Well, with me, Standard Bank consumer economist, Siphamandla Mkhwanazi. He joins me now. Siphamandla, thanks very much indeed. I mean, this could have been some sort of a surprise because no one would have thought we were this close to getting a hike, and we were.
It was very close. It was very close. I suppose we did anticipate that they're going to leave it interest rates unchanged, but I wouldn't have expected them I wouldn't have expected the voting split to be this close. So this does suggest to us that the risks to inflation are really to the upside, and the governor did mention as much. I read the statement to be hawkish, meaning that the risks to the inflation are to the upside, and therefore possibly we might start seeing interest rate hikes in the next 12 months or so.
Before I continue with this interview, I think it's prudent to just get the context right here. And I know this is an elementary question, but we listen to the governor after every 2 months. He announces this MPC statement, and it's long, sometimes tedious, very complicating. There's some economic jargon in there. Why is it important for consumers to pay careful attention to what he's saying, despite the fact that the interest rate didn't move?
Devan, it boils down to planning, really. Businesses are looking at this, international investors are looking at this. For us as consumers, should be planning around what we think, what the interest rate is today, and what we think, or what the governor thinks the interest rates are going to do going forward, because it hits directly to our pockets. For example, if you have a car, your car payments will go up if interest rates were to go up. If you live in a house and you're paying a bond, your bond payments will go up if your interest rates go up. So it's really all about planning for the consumer.
Yeah, and it does affect business in terms of investments
exactly.
as well. Let's get into what he's saying about inflation. So he says inflation, there are upside risks, but overall the sentiment is that it's benign for now, hence they wouldn't raise interest rates. He does say the model puts about 5 interest rate hikes before 2020s. Notice no cuts mentioned there.
Yep.
Which means that if you look at the rand volatility, you look at oil prices and its effect on petrol prices, he does see inflation on the upside here, and that's the important point here, isn't it?
Correct. You'll remember that the first round effect, he did mention as well that the Reserve Bank is going to look through all of that noise, because there's not much that the Reserve Bank can do about that. They'll only start worrying once those factors start playing themselves out in the price formation in the domestic economy. Their model, they say it's a broad guide, so if anything could be read out of it, I would say that it just gives you the potential direction of interest rates, not necessarily saying that there are going to be 5 interest rate cuts, interest rate hikes up until 2020. It's just giving us the broad direction of interest rate from now to 2020.
The consumer sits down, looks at this and says to the Reserve Bank governor, I suppose in his or her mind, well, please give me a interest rate cut. Allow me that little extra cash that I'm paying on my home loan, because we are in the recession, something the Reserve Bank governor emphasized. But I see very interestingly, Lesetja Kganyago telling us this afternoon, the Reserve Bank is not in the business of stimulating growth in that fashion. That's a very interesting, he emphasized that.
Very hawkish statement. Correct in my opinion that the monetary policy, their core mandate is not necessarily to stimulate growth. Our growth woes are actually about the structural effects. They are about the structural. They are structural more than cyclical at the moment. So, monetary policy actually works on cycles. It counteracts cycles mainly. Hawkish statement, in my view, he is dispelling all of those arguments that the Reserve Bank, we've heard from the unions yesterday, that there were talks about putting pressure on the SAP to cut interest rate in this economic environment. So it's dispelling all of those arguments, saying that our core mandate is to protect the strength of the currency and not growth. But that's not to say he does not care at all about growth.
He spent a lot of time answering one of the questions, Siphamandla, when it was put to him, how important is that inflation figure staying around the midpoint. That midpoint would be around 4.5%, I would think.
Correct.
We saw inflation yesterday, 4.9%, but there is a tendency that inflation might actually be on the upside here. And just for the sake of it, I see he says that it's extremely important that inflation stays around that 4.5% midway in between the range of 3 and 6%. And the moment it starts to move, that's when the Reserve Bank will move.
Correct. That 4.5, he correctly pointed out that it gives them a room to maneuver should there be a shock, both domestic or global shock. What's important as well is the impact that inflation expectations have on the Reserve Bank's decision now. You would remember that the Reserve Bank cannot do anything about current inflation. They can only control inflation expectations, the forecast of inflation. So if you were to convince the stakeholders, business stakeholders, unions, workers as well, that you want to anchor inflation around the midpoint, the expectations automatically would be for inflation around that target. So that also helps in the setting of wages. We know wages tend to have a second round effect. If they are around 6%, we will start seeing inflation going towards those 6% levels. So it's important that it's kept around that midpoint of 4.5.
Indeed. Siphamandla Mkhwanazi, consumer economist at Standard Bank. Thanks very much indeed for coming and explaining to us. Well, that's where we leave it. Just a quick reminder then that the Reserve Bank leaving interest rates steady. Your prime lending rate at banks stays at 10%. And of course, the Reserve Bank governor pointing out that although inflation is benign, there are upside risks to it. And I see you've joined us on set to Lesizwe. So there you go. That interest rate staying steady for the moment.
Our first interest rates decision since we entered that technical recession, Devan. And I see tomorrow President Cyril Ramaphosa will unveil details of the stimulus package. Lisicha Khanyago basically saying that I've done all I can from my side in as far as monetary policy is concerned. I can't help you any further. But I do have one question for you guys. It's about this concept of the implied path, right? I mean, if I take the example of the increases we've seen in fuel prices, it's 20 cents here, 25 cents there, but over a period of time, you look at it, it's well over 2 rand, almost 3 rand, or even more. Is this a similar concept where they're talking about the possibility of 5 rates hikes by 2020? That worries me if I have any debt to pay.
I'm going to throw it to Siphamandla in the next 10 seconds, but let me say this much. I mean, that basically tells you that you've got to be more prudent. Petrol prices are going up. If anything, the model suggests that you will get 5 hikes. Why should I worry about that, Siphamandla?
Because it's directly into your pocket if that were to happen. For example, if you drive a 400,000 rand car and you live in a 1 million house, a 25 basis points hike, just one 25 basis points hike, could increase your monthly installment by a combination of about 220 rands or so. That's quite substantial, although a 25 bips hike alone is small, but it accumulates, it adds up. If you're going to add the cost of living, petrol prices as well, and on top of that.
All right, guys, thank you so much. You've got me totally worried. Thank you.